Hello, everybody, and welcome to the NASDAQ Dorsey Wright podcast for Monday, February the 8th. I'm Jay Greg Danny, and here joining me this week is Sara. And gosh, Sara, hard to believe we're talking about February, and I guess this is the second podcast now in the month of February of 2021. And hope everybody had a great weekend. Hope everybody had some time to tune into some history in the making that was yesterday, given the Super Bowl and Tom Brady's seventh Super Bowl victory. But as it relates more to us, there's this old indicator, this old adage out there that looks at, it's called the Super Bowl indicator. And by no means is it scientific in nature, but it's always interesting to look at. And one of those things that, has had some pretty interesting history going back to it. But basically the way that it works is, historically, if an AFC football team were to win the Super Bowl, that has historically not been a very good thing for the market. That has suggested a weak period coming for the market for the remainder of the year. On the other side, if an NFC team happens to win, which the Tampa Bay Buccaneers are an NFC football team, then that historically has been a good thing for the market. And so for those of you who follow the Super Bowl indicator, that is certainly a feather in the cap for the equity market for the remainder of the year. I think so far up to this point are still generally positive for the year, and we're continuing to see strong performance out of equities really across the board as we're moving into now the second week of February of this year. And we'll talk specifically about some areas, not really up and coming areas, but areas that have been doing really well for some time being now, namely looking at some of the small cap areas and then also some of the sectors, recent changes and recent trends within the sector strength. But as is the case, there's a lot of different market indicators that many people look at. And while things like the Super Bowl indicators are always fun to talk about and look at, for us, it certainly is looking at our equity indicators that are driven based off of price action over time. And when we take a step back from that today and we look at our DALI rankings, which is just our broad asset class ranking system, dynamic asset level investing, we continue to see domestic equities or U.S. equities ranked number one with 325 buy signals, which is the most out of any asset class right now. International equities coming in at number two and commodities coming in at number three. And we've seen, a pretty decent resurgence within commodities having been the most improved asset class this year, but has not taken away any of that strength from the U.S. equity camp. So right now we continue to see U.S. equities in the lead, Sara, from a relative strength perspective, but we're also continuing to see positive developments out of a number of our other equity indicators as well.
Yeah, Jay. So today it looks like, based on today's intraday action, that we're going to see a reversal up on the bullish percent indicator for the New York Stock Exchange. So that's the BP NYSE. And as a reminder, this, is recording the percentage of stocks that are trading on point and figure buy signals. So, we saw this particular chart reverse down on the 27th of January after we saw a number of stocks move to those near-term sell signals. But we do note that, that came in the confines of a generally positive trend. So, our PT indicator for the New York Stock Exchange remains in X's at 76. So we saw a lot of charts move to near-term sell signals, although they stayed in those positive trends. And then it looks like, over the past week or so, we've seen a lot of those charts return to point and figure buy signals. And so with that, rising number of stocks returning to buy signals, we see this particular chart reverse up into X's back to 72 after a brief reversal down to 66. So that puts that indicator back on offense. The bullish percent indicator is heavily skewed towards those small and mid cap stocks. And another development that we've seen today, along with that bullish percent indicator rising, is we also saw the IJR, so that's the iShares S&P Small Cap 600 Index Fund, give its sixth consecutive buy signal today at 104, and also marked a new all-time high. So IJR has been on fire lately. It's actually one of the best performing major market funds so far this year. Through Friday's close was up 12%. So this is another adding on to the weight of the evidence for small caps. So I do note today with this buy signal, the IJR is now about 90% overbought based on that intraday 10-week trading band level, overbought, oversold level. So it is entering, that heavily overbought territory. But again, the weight of the evidence here for small caps is, holding strong. And another area that we've seen kind of the small cap, micro cap strength resurgence is going to be on the asset class group scores page. Today we've seen the micro cap group, move to the top of the ranking. So out of all 135 groups, we track on the Dorsey Wright platform, looking at ETFs and mutual funds, the micro cap group right now is the highest scoring with an average score of 5.29. And, this is one of the highest scoring one of the highest scores that this particular group has managed to have. And then within the microcap group, you're able to click on the ideas link, so that blue ideas link, and the highest scoring ETF at this time is that Advisor Shares Dorsey Wright Microcap ETF, symbol DWMC. So that's one of those ideas if you're looking for some microcap exposure. And then we also have the iShares Russell Microcap ETF is right behind, so that's IWC. So continuing to see the strength from small caps and microcaps. And Jay, we've also seen some strength from energy.
Yeah, the small cap and micro cap strength is certainly interesting to see. As you see a lot of the headlines obviously grab the big stocks are making a lot of the big headlines, but some of the small stocks like micros and small cap stocks are the ones that have been doing very well, performing very well. Similarly on the sector side, for many years now, it's been about technology and it's been about the growth oriented sectors. But it's been interesting here to watch the sector rankings and in a number of different levels, whether you're looking at the dolly sectors as an example. We continue to see two traditional growth oriented sectors, consumer cyclical or discretionary, as well as technology, are still up there in the top two spots. But energy and materials, those two sectors have made tremendous strides over the course of the past couple of months. As a matter of fact, energy is currently in the number 3 position in terms of its sector ranking. Materials just behind it at number 4, and then really healthcare. Those 3 sectors, energy, materials, and healthcare, those are all strong in the top half of the sector rankings, with energy over the course of really the past number of months being the most improved sector that we've seen. And that has been consistent for a few months now, and we've seen that not only on the commodities, with whether it's crude oil just today, very briefly touching $58 a barrel, settling just below $58 a barrel, and that's the highest we've seen in over a year now. You have to go back to January of 2020 since we've seen prices for crude oil above $58 a barrel. Natural gas continuing to perform well. So a lot of the energy commodities out there have been performing well, which ultimately has then positively benefited the energy companies and then the energy stocks. And when we talk about sector rankings within Dolly specifically, those are looking at equity related commodities. So think your Exxon Mobils, your Chevrons of the world being your large traditional energy companies, but then also the clean energy space is a piece of that. The clean energy space has been a big driver of performance, especially last year in 2020. Some of the best performing ETFs out there were some of the more thematic clean energy, alternative energy type of areas, and so those companies that are involved in the alternative energy space, are certainly doing well. But as are the more traditional energy companies, and you look even on a day like today, XLE, which is the Spider Select Sector Energy Fund, up over 4%, and we've seen some of the momentum driven funds like PXI, which is the Invesco DWA Energy ETF, up over 7% so far in the day. Nonetheless, what was interesting as it relates to those two, energy and materials specifically, the more commodity related sectors out there in the market, both of those sectors, materials, symbol PYZ is the ETF, as well as energy, symbol PXI, both of those sectors just this month, so last Monday on the 1st, were added to the DWA Sector 4 model that we run. And again, for those of you who might not be familiar with the Sector 4 model, Basically, what it's designed to do is look at a universe of 9 different sectors that they're all the Invesco DWA momentum related sectors. There's 9 of those, and then money market or cash is a position in there. And so what the design of that model is really looking at to own up to 4 sectors based on their relative strength rankings, and then has the ability to raise cash if cash moves up in its ranking. Has the ability to go all the way up to 100% if need be, but it could also be 25, 50, 75% in cash, given where that money market ranks. Now, nonetheless, when we look at the holdings today, the top 4 sectors are consumer cyclicals and discretionary, which is very consistent with what we saw within Dolly. And then we see materials, we see healthcare, and we see energy rounding out the top 4 of those sector models. So, we continue to see strength there across the energy space. If you drill down into the energy sector here, the holdings of PXI, while it's digging from the broader energy space, the holdings right now can look very, very different than that of, say, XLE, where XLE is going to be very, very cap weighted in terms of its holdings, a big exposure towards names like ExxonMobil and Chevron, which, of late have certainly been doing well. PXI so far year to date has done well, up almost 24% prior to today. If we look at the holdings underneath the surface, and so what that ETF is designed to do is really trying to seek the best performing, best momentum, or best relative strength names within the energy space. We very much see some of that theme of clean energy, renewable energy, alternative energy names making their way up in the portfolio, as well as some of the traditional energy names like a Chevron, like a Marathon Petroleum, Marathon Oil, and even Marathon Petroleum and ConocoPhillips. So you see a pretty interesting mix within there of some alternative clean energy names, as well as some of your more traditional integrated oil companies as well. So lots going on in the market as we're heading into February, but certainly, the resurgence of small caps and the recent move to #1 within micro caps is something worth noting right now. That's an area of the portfolio that might be a little bit underweight. Now might be a great time to be looking at some of those, more smaller micro cap type of companies, as well as the energy and materials, the more commodity related equity exposure. We'll have to see. I mean, commodities in general, crude oil, gold, silver, all up on the day to day, a lot of strength from energy names. And so one of the things that will be interesting to watch is if we continue to see net new buy signals coming from commodities as it relates within the Dolly rank. So that'll be something to continue to watch over the course of this week, and as things continue to play out from there. So with that said, as always, we certainly appreciate you joining us for these podcasts. If there's anything that we can do to help you in your business, please don't hesitate to reach out to us and let us know. But with that said, thank you again for your time, and we look forward to talking to you next week.